Everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending Jan 22nd, 2021. It was a holiday shortened trading week here in the United States. I'm Preston Brent. Thanks for tuning in. Remember, you don't want to be a rat brain trader. You want to be the red striped zebra. Stand out from the crowd. And this week's theme is too much cowbell. So, cowboy saying. Let's take a look at how the markets did this past week. Everybody, it's a fairly good week, but I'm seeing the market price action acting a little bit spongy. So let's just kind of come in and let's take a look at first the U.S. performance. You can see everything is in the green for the week. Looking at the weekly performance in the upper left corner, you can see both Dow, S&P, NASDAQ, Russell, all up for the week. NASDAQ had a really good strong showing. I'll show you that in just 1 minute. We had a really good comeback and a whoosh by the FANG stocks this week. Year to date, everybody's up fairly good, 2-3 weeks into the new year. But look at the Russell, 8.94%. We're not even, we still have another full solid week left in January. Trailing PE ratio, 41.74, Ford 23.42, so it's lower by about 43%. So the PE ratio is still elevated in my mind. Dividend yield is up 1.55%, 10-year Treasury, a little over 109 basis points. So the spread between the two is 45.9 basis points. So that still encourages money to go into the equity markets. But at these stretched valuations, I think we're going to see big money sit on the sidelines a little bit. Volatility came down for the week. Obviously, everybody was in the green. Last week it closed at 24.34. This week 21.91 for a 9.98% reduction for the week. And then you can see the best performing sector for the week, technology, a big whopping 5.45% for the week. Worst performer, materials, 1.65. Still leading the way for the year. Energy, it was bringing up the rear in 2020 and 2021. It's leading at 8.73%. Consumer staples is bringing up the rear year to date, 5.80%. And if we look at the rest of the market, some of the large global markets, you can see that the FTSE and the CAC 40 were really the only two in the week that were in the red. But essentially, basically flat. DAX, the Nikkei, right? China, Hang Seng. Hang Seng had a very strong week, up 3.06%. Year to date, everybody's in the green. So everybody's in the green year to date across all U.S. indexes and some of the major world indexes. The one that's leading the way is the Russell, 8.94% of all the big indexes. Hang Seng is, number two at 8.14%. So all in all, a fairly strong start to the new year. But again, price action's getting a little bit soft. If we take a look at a little bit more detail behind this, let's just take a look at the weekly sound bites. We look at the market index performance for this past week, besides the numbers there, it was a holiday shortened week, as I said, for the U.S. Martin Luther King Day on Monday. But we hit new intraday highs Thursday before a little bit of a pullback this past Friday. And as I said, fast-growing technology-related stocks led the gains for the week, all right? And this big rotation that we've had into small cap and value stocks, it's been going on really since November of last year. Slowed down this week. I mean, we're still seeing small caps in the Russell moving up strong, but at least a slowdown this week, and the FANGs kind of caught on. I'll show you a chart here in a minute that kind of just spells it out a little bit more. This past Tuesday, our former Fed chair, Powell, or current Fed chair, I guess, Powell, and Treasury Secretary nominee Janet Aunt B. Yellen, they basically told the Senate Finance Committee that it was necessary to act big, dump more money into the economy. So the markets like that. Also, they really liked when Aunt B came out and said, we want to hold off on raising taxes until at least we get the economy supported better and get more vaccines out in distribution. So the markets like that. The month of February, just as an FYI, when we have a new president in the month of February, the month after the new president sworn in has typically been the worst trading months of the year. Since 1927, with a new president in, February's fallen on average about 4%. I think we're still looking for a 10 to 15% pullback sometime in Q1, so we got to be careful, all right? And of course, if we look at the economic data for the week that supported these numbers pretty much in the green, is a relatively light economic calendar. Okay. So it didn't really play a big role in driving the markets, but we did see weekly jobless claims pull back a little bit to about 900,000. We got some good data out of manufacturing services activity as well. Housing sector still remains pretty good shape, right? In fact, we're seeing existing home sales and housing starts at the highest level since 2006. So we got to be careful here. Remember, housing peaked in '07 and then '08. We just had a big, massive bubble blow up. I think it'll be a little bit different this time, but I would be very careful with housing. We're also seeing lumber prices through the roof. So I'm looking at lumber as a possible way to short. I think it'd be real interesting here. Uh, and of course, if we look at the treasuries for the week, treasury yields basically remained steady most of the week. We didn't see them just screaming higher or lower. Generally positive economic data, which would drive yields a little bit higher, was kind of offset by downward pressure on the Feds continuing to purchase the front end of the yield curve. They're just doing a lot of QE purchasing to the tune of 120 billion a month, 80 billion in or 40 billion in mortgage-backed securities and 80 billion in treasuries. Okay, so the markets are basically the credit markets are still holding up fairly good. And then of course we come over to China. A lot of good news out of the Chinese economy, and they're happy, of course, with Biden in. So their economy officially grew in the entire year of 2020 at 2.3%. The only one that of the large majors that really grew. The forecast is just basically showing just a huge recovery in China from their prior year COVID lockdown. Their Q4 GDP also accelerated to 6.5% year over year, which helped lift up their annual to 2.3%. Okay, so China is really the only major economy, as I said, that has regained its pre-virus trend. And then this past week, Chinese stocks, as I mentioned, rallied relatively strong, okay, on hopes of a warmer U.S.-China relations under wrong way Biden. We'll see what Biden does, if he even knows what he's doing, but we'll see. We're going to get an early test, meanwhile, with the U.S.-China relations. China is, their three biggest telecom companies appealed to the New York Stock Exchange of their recent decision to delist these companies, okay? So we're expecting to hear something from NYSE in about 25 days. So we'll see what's going on there. Meanwhile, on the COVID front with China, they've locked down 22 million people. But the way they do lockdowns is a lot different than what we do here in the U.S. or in Europe. They build concentration camps. They lock you in home. You're not going anywhere. So they just kind of just bring it right back down. And they're doing that in the Hebei province. 22 million people. We'll see how that shakes itself out. Now, what I want to do is I'm going to take you over to the charts. And the first one I'm going to do is I'm going to show you I made a special index of the FANG stocks. All right, I'll show you that breakout. So let me just get that on the screen for you guys. Let's see, here we go, right here, that screen number 4. I got 12 monitors on my desk, so it takes a bit of time to kind of ferret it all out. So it's going to be a couple of seconds here, but what you're going to see is an index, a FANG index that I've made that, and I've applied a multiplication factor to make the weightings fairly equal. In this FANG index, I've got Microsoft, Facebook, Apple, Netflix, Google, and Amazon. Netflix reported earnings last week and just blew the doors off everybody. But look at this. We've been sitting in a fairly steady state, go nowhere market since the highs back here in September the 2nd. And then we just came up. You know, we had that, like everybody did in September, it fell, kind of came up about 50%, and then we just bounced around, right? And then we finally broke out right here, and we came right back up and actually made a new 2020 all-time high for this specialized FANG index, right? While we were chopping around in here, the Russell was just going to the moon. Small cap and value stocks were moving very strong, and the FANG index and FANG stocks were pulling back or just running sideways. Well, over the past couple of days, big moves higher. I mean, big move. And that helped lift the markets, a little bit of market sentiment too. If we zoom in on this a little bit, you can see here the gap up. All right, let me just widen it up so you can see here. Look at this gap, guys. We went from down here all the way up here in a nanosecond. 3 days, boom, boom, boom. Money poured into the fangs, into some of the high cap tech, big time. Now, if we look at the Russell, look at the Russell futures, same thing. You can see here from November, we were in the red, about 7% year to date in 2020. And then boom, we just moved straight up. And if you weren't in the Russell, or if you got out of the Russell in November, the whole year for the Russell was made in November into December. And now you can see it's leading the way to the upside. You can see the 2020 closing price, so we're well north, close to making new all-time highs in the Russell. We actually made all-time highs in the Russell on the 20th of January, so this past week. Okay? Really strong. If we look at the E-minis, what I'm going to do is I'm going to shift it over to a couple of different charts. Let's go look at the 4-hour first. Let me just find this on my screen here. Where are we? Right here. Here we go. I'm going to take you over to the 4-hour chart. I like the 4-hour chart sometimes much better than the daily because it's kind of like an X-ray view of how the charts look. And what you're going to see on this chart here, you're going to see a couple of things. One, we made new all-time highs here too on the 20th, like the other indexes. But you can see this volume over price. So there is a mass amount of volume underneath the price here, sitting right around 3,800. So a pullback to 3,800 to me would make a lot of sense, okay? And then there's a lot more volume down here, sitting around 36. I'd call it about 3,700. So these are two touch points that I want you guys to just keep in mind over the next 3 weeks. This area right here, okay, roughly that area right there, and then this area right here, okay. So these are going to be kind of like my short-term S1 and S2 values. Now it is a range, right? So it kind of comes all the way down to 3650 roughly. And in this area here, you can see we held up just a little bit. So these are kind of going to be what I'm looking at over the near term. You can see we made a high here and then a higher pivot high right here. And then we got a high cross here, and then a slightly lower cross right there, a little bit of a divergence, but it's what we call our poor man bed because we had multiple crosses to get to this final cross right here. So typically when you have that, that just means be ready for a little bit of weakness in price, and that's kind of what we're seeing. So you can see we've got some buyers sitting right here, and if they're not strong enough to lift the markets back up, then we got a pretty good group of buyers down in this area down here around the 3680 down to 3650 level down here, so we could call that a support zone. Okay, now if I were to put my ruler on this chart, let me just come over here, and I'm going to come over here and just select this right here. Let's just put the ruler on it and just kind of give you an idea of a pullback from this point right here. If we come down to my support zone down here, that's only about 4 or 5%. Remember the stat that I told you in February, 4% is the average pullback in the first term of a new president in the month of February. It's the worst performing month, and then things get on track. So this would take us right down to this zone right down here. If we come down a little bit lower, in fact, let me widen this thing out here. So let me just get this all off the screen. And we'll take a step back here. So let me just delete my drawing tools on here. And then let me just zoom out a little bit. And we get what I'm looking for. I've got a couple of touch points, pullback points, sitting here around 3,600, which are Gann and Fibonacci derived. But if we were to just look at the touch point here, and I got to fix that. I don't know why it's 2019 closing price. But let me just get in here and let's put the ruler back on again. And we start right up here. And we come down to about 10%, which gives us an official correction territory, right? So it's right around 3472. So let's call it 3475. So the 3500 area would be another area that I'm looking for sometime in Q1. And, you know, anywhere from there to 15% takes us right down, right around to 32, call it 3300. So 3300 to 3500. Sometime in Q1 is what I'm looking for, okay? Now, I am still bullish the markets. I believe we're going to have a strong finish towards the end of the year because the year-over-year comparisons is just too strong, okay? But I do believe we're going to get a scare the children moment we'll get that out of the way. And then the market's going to want to bull higher. I mean, I can just see that, at least on the charts right now. I don't see anything that would indicate otherwise, right? From these price action here. Let me just switch you back over again. I just wanted to show you that chart. I'm going to switch back over to my original screen here. Let's get it back over here like this, screen number 4. And what you're going to see when it comes up on the screen here, I'm going to take you down to volatility. Volatility is still staying very high here. So if we come over here to the VIX, let me just see, where are we sitting right here on the VIX? I know you're in here. Here we go, right here. So the VIX up a little bit on Friday, but you can see we're still in this red zone towards the lower end, but we've just been chopping around. We have these little spikes higher, and these zones are determined. We look at these different option strategies you can deploy depending on what the VIX is sitting on right now. Okay, it's between the lighter red shade and then the yellow. Green is way down here. This is the longest we've been over 20 in quite some time. Okay, even in 2008, we didn't stay over the 20 VIX this long. Okay? I did tell you guys back over here, back in March, when the VIX went way up, bloody murder higher. Let's just take it out to a weekly. We went into black swan territory up here, so you can see the colors. Anything over 50 is a black swan, and it just, VIX does not climb up to the 50 area slowly. It gets up there very quick, typically with surprises in the market, and you can see it went all the way up to 85.47. Now we had a higher VIX in 2008, 2009, but it stayed higher longer this cycle. And you can see we're just bouncing around down in this area right down here. Okay, I think the markets are waiting to see how the vaccine deployment is going to come about. And that's going to be the big thing, and just how quick governments and local cities, municipalities can open back up again. We'll see how that works, how that shakes itself out. Of course, if we look at the bond market, you can see here the bonds are doing exactly what I've been telling you guys it would do. Really a good trade for us. What I call low-hanging fruit trade. Anytime the bond market got up above the 50 EMA, you wanted to be a seller of bonds, which meant you believed interest rates are going to just edge higher. And that's what they've done, right? Now, I would not short bonds down at this level here. I think we're going to get a bounce back up. When we do get that pullback in Q1, you're going to see a flight to safety. So you'll see people buying bonds. It's going to drive bonds higher, interest rates lower. But then that'll be a time to take the counter trade, let it get up a little bit, and then if bonds get back up over in this area here, I'll be happily shorting bonds. Okay, that's what I'm looking at in the bond market. Of course, if we look at the 10-year interest rate, you'll see it closed the week at 109 basis points. But look at that breakout. I mean, let's just break it out here. Let's just zoom back. Interest rates are moving up to this 1.25, 126 basis points right in this area here. I think we can get up here before we get too much damage to the equity markets. Then once we get up here, you're going to see interest rates are going to start competing with equities for where money goes. So we may see some allocation changes in big money. That'll have a tendency to push equities down just a little bit. But let's make no mistake about it, even below 2%, interest rates are very low. So it forces money further out on the yield curve. It forces money to take more risk than they normally would, pension funds and so forth, to hit their annual nut of 7+% to keep funding their Ponzi scheme that they got going. So we'll see how this plays itself out. But any short-term drop in interest rates or rise in bonds should be played the opposite way, because it'll be just a counter move. And then if we look at currencies, again, let's put it back on. You can see here on the daily, this was part of the low-hanging fruit trade that I told you guys about. Down in here is bull put spreads, right? Credit spreads down here, or bull call spreads. In the money debit spreads, those are really good. You can see the currency came right back into this area here, touched the 50 EMA, and is going to kind of slowly move up again. So that to me is a possible buy point. Now remember, if the markets do get that 10 to 15% pullback, this is going to go even lower. Okay, you can see a projected Elliott wave count shows it running lower. I don't think it's going to get down here. I think it's going to come down a little bit when we get the drawdown in the equity markets. But I think that'll be a time to go long. So we want to be more long the euro than short, just like the dollar, which is a very crowded trade, by the way. If we look at the US dollar, Again, just like bonds, anything over the 50 EMA, which is this red line, you want to be seller, not buyer. And when it gets up here, you just want to sell it. You don't want to chase this thing down because it's such a crowded trade right now, guys. I see it consolidating for a period of time. If we do get the pullback in Q1, then you're going to see the dollar move up in a flight to safety. But then that'll be a better opportunity to get a better short price for this thing. It's the way I look at it. The other one, longer term, that's going to be bullish is the British pound. You can see here, I've been talking about being bullish of British pound for quite some time. I said it's a very choppy trade until they get the Brexit done. And now it's going to be not quite as choppy, but it'll still be a little bit choppy because you're going to get week to week reports on trade deals, good deals, bad deals. That's going to continue to keep it choppy. But I think the British pound's going to move up into the mid 40s, 145, 146, something like that. So the mid 40s. I think that's going to be a good trade. Okay, currencies tend to trend. That's just a beautiful trend off the lows. It's choppy, but it's going in the right direction, right? And there are a number of ways, as you guys know, especially members in our group know how to play this, right? Play the chop, but play it to the upside. So that's just a little bit about what I'm seeing on the currencies that I really like, okay? And if we come down here and we look at metals, gold, I am still neutral to short. I think it's just, you can see it here every time it's trying to get back up above. We had a breakout here and it came right back down, did a retest and came back below. Now it did a retest here about 3 days ago. It failed. It couldn't get above. And then right here, also notice the 50 EMA sitting there. For me to be more bullish gold, I want to clear this 1960, 1970 area right there. It's pretty strong. Okay. I want to be able to clear it. So there's just really nothing to do with gold right now, unless you want to play day trade, but I'm not going to do that. Same thing with silver. Silver had that big breakout. It led gold higher, okay? And now it's just coming down pretty hard. It's holding the 50 EMA. I wouldn't play silver to the upside right now either. I think longer term, both these are going to be higher. Near term, no. Oil, well, oil, I think, in my mind, I don't think it's going to come back down to this 45, 46 area, but you know what? You can make this play. All right, I don't see any divergences in the trade, so I think oil, if anything, is going to go neutral to slightly higher. All right, it may reach a limit in the upper 50s, 58, 59, somewhere in this zone here. But and it may pull back just a little bit, but that'll offer an opportunity to play it to the upside. Do it with unbalanced call condors. That makes the most sense, or unbalanced call flies. I like those trades. All right, so these are just some ways to play the oil market. Members, we've gone through some of these before, so you guys should be pretty much on board with them and how we play these things. Nat gas, any rally should be sold off. As you guys know, when it got up in this area here, I said I'd be more apt to sell it than buy it. And now it's going to come down and test the 200 EMA. I don't think it'll hold. I think it'll come back down and challenge this low down here. Over time, I think that's what we're going to see. Okay. So these are just some of the things that I'm noticing here in the markets. Members, there are a lot of stocks that we're going to take a look at this Sunday evening. There's some really interesting plays. We'll kind of review that GameStop stock, and that's just a beautiful one to want to play. So we'll take a look at ways that we can take advantage of it, but not the way you think. All right. Same thing with Tesla. We got some big earnings coming up next week, which will be really interesting. We got Apple, Facebook, and Tesla on Wednesday, I believe, after the markets close. So there are going to be some interesting things to take a look at there. Got some other big banks and things coming out this next week too. We also get Microsoft on Tuesday. So we're getting Microsoft, Apple, Facebook, Tesla, some really big ones hitting for the week. Okay. We also on Thursday of this coming week, we get first pass of Q4 GDP number. Expected, I think, to come in around 4.3%, right? And with FOMC meeting week, we get they're not going to change the interest rates, but everybody wants to dive into what they may do with their quantitative easing. They're currently discussing this. They're probably going to keep it up for a while, but remember, last time they tried to cut some of their quantitative easing, the markets didn't like it, all right? Came down pretty hard. So this week we do have some economic data and some events that are happening that could make the market a little bit more volatile than this past week. All right, everybody, have a really great weekend. Members, I will see you this Sunday night for our weekly market watch. If you're a non-member, love to have you come in. We're having fun. 2021 is going to be a really great year for us. I see some really good opportunities surfacing, some where you may not even think. All right, everybody, have a good one. Thanks. Ciao now.